Tonight's keynote presentation is how to buy properties subject to the existing financing, how to buy properties without relying on a bank. And one of the things that we talked about earlier tonight was the fact that real estate investors actually have a glass ceiling. And that is that lenders usually will only loan somewhere between 4 and 10 loans to an investor, including all of their LLCs, because even though you own property in an LLC, it is still tied to you, right? So don't think I'll just get new LLCs and I'll get new loans, because no, they figured you out and they're smarter than that. But most real estate investors find that 4 to 10 properties is not really going to build the cash flow that they're looking for, is not going to build the wealth that they're looking for in order to have that mailbox money and in order to retire. So tonight's keynote presentation, we're going to talk about some different strategies that you can use as a real estate investor to be able to bust through that glass ceiling and to be able to acquire more properties and do it in a way that will cost you less money. Let me take a dramatic water break. So for us, what we've found is buying subject to the existing financing is probably one of the most powerful strategies that we have used as real estate investors. There is never not a time when someone brings me a deal or I'm talking to a homeowner where I don't ask if I can keep the financing in place that the seller already has. Why is that? Because even though we have some great hard money lenders as part of our association, the hard money lenders that we have usually charge anywhere from 2 to 4 points to originate a loan. So if you're buying a property and it's a $200,000 property, if you're paying 4 points, which is pretty typical, that means you're paying $8,000 to be able to originate that loan. That's a pretty big chunk of money, and that is a chunk of money that comes directly out of your profits as a real estate investor. Now imagine if instead you could just take over the payments on someone else's loan, right? And in that case, you would not be paying 4 points. That's a big deal. And then typically for our hard money lenders, as an example, you're paying about a 14% interest rate. Well, typically for the loans that we buy subject to the existing financing, the interest rate is usually half that, and in many cases, sometimes significantly even less than half of that, right? Imagine what you could do if you're saving maybe $500 a month every month at least in terms of your interest payment, right? That's a big deal, and that comes straight out of your profit. So for us, that makes it a very powerful strategy. You don't really have to come up with a whole lot of money other than the reinstatement if it's behind, as well as the closing costs to be able to close on it at a title company. But it is a great money to buy property with as little as no money, right? Just bringing the closing costs. And essentially what you're doing is you are taking the deed to that property, so the deed goes into your name, the investor's name. The loan that was in there, the loan that the seller got at the time that the seller purchased the house or refinanced the house, if that's the case, that loan stays in place. Now you are the one, as the investor, who's making the payments on that loan going forward each and every month until the time that you sell that property, pay it off with cash, or refinance that property. So for us as real estate investors, when we don't want to bring all cash to closing, or when we don't want to borrow money at very high interest rates, buying subject to the existing financing allows us to be able to not only buy as many properties as we want, but also buy them at a lower cost of capital, which allows us to do what? Even more deals, right? So we always want to keep our powder dry as real estate investors, especially here in the Austin market when the prices are so very high, right? We want to be able to do more deals, and if all of our capital is constrained into one deal, it limits our ability to do that. So for us, what we found is it's a great way to pick up rental properties. It's a great way to pick up fix and flips, homesteads, and you can also do wholesales with them. No property is going to sell faster than a property that already comes with financing, because it doesn't take any extra steps for someone to get it approved. The details can get a little complicated, more than a little complicated, so we'll go through what all of those details look like tonight as we go through the presentation. And we'll tell you that, again, for us, we use it for our long-term holds. We're just looking for a low fixed interest rate loans. Our short-term holds, we're looking for just not getting a reverse mortgage. So a reverse mortgage is a mortgage that someone maybe took out because they were essentially trying to pull some equity out of their house, maybe to do some repairs, and they were no longer working, so they didn't have the money to be able to do that. But in those cases, we don't like to have reverse mortgages unless the owner is still alive, and unless we think we can finish the project while that prior owner is still alive. Now, every time you close a real estate deal, not just a property that you're buying subject to the existing financing, but every time you buy a real estate deal, you will want to close at a title company. After almost 16 years of investing, I can count on one hand the number of times that I have not closed at a title company, the amount of exceptions that I have had. Now, the reason why I do that is because I want someone to provide that title insurance. I want someone who can professionally check that title and look for the things that I might have missed. Some investors get penny wise, pound foolish, and want to create their own general warranty deed, and that is all fantastic until something goes terribly wrong, right? So especially if you're just getting started, and especially on a deal like this where it's a wraparound mortgage, is buying subject to the existing financing, you'll want to make sure to close with a local title company to make sure you stay within the parameters of the law, make sure that you've got the title work done properly and all of the corresponding paperwork that goes with a transaction like this. Now, some of you guys might be familiar with something called the due on sale clause. The due on sale clause is a clause that is in just about every single note and deed of trust that is out there, that's been originated since the mid-90s. And it basically says, in the event that the property is sold, if the loan is not paid off, like it traditionally is on a normal closing, if the loan is not paid off, then the lender may, at its option, call that loan due and payable in full. Okay? For a lot of people, that clause makes people incredibly nervous and incredibly scared about buying property subject to the existing financing. In truth, though, it shouldn't make you too scared about buying subject to the existing financing, as long as, number one, you make your payments on time each and every month. What we've found is that banks usually don't care who owns the property, they just care that the payment on that property is actually being made. Does that make sense to everybody? Yes, yes? The other thing that we want to make sure is we want to make sure that we have our insurance correct. That's one of the items that you could cause to get your loan called. You need to make sure that your insurance and your declaration page states you as the owner, but you also want to make sure that it states the prior owner as the additional insured. Pardon me, guys. Because the bank will look at who the additional insured is and who the insured is, and they will compare it to whose name is on that note. The other thing that you need to do, and this one sounds kind of obvious, but I'll go ahead and put it out there, is you need to make sure that the old owner, the prior owner, the person you bought the property from, doesn't go to the bank and say, hey, I sold this property subject to the existing financing, and I'd like you to take this off of my credit so I can go out and buy another house. Okay? That's a surefire way to get that note called. So you do have to have that conversation with the owner just so they don't go out and do something like that that would cause everyone to get in trouble, including them. Now, I will say, and I'll knock on wood as I say this, after 16 years of buying properties subject to the existing financing, I have never gotten a note called. Why is that? I always pay on time and I have the insurance correct. I do have a colleague that did get a note called. They were making their payments on time, the insurance was correct, but the seller went down to the bank and said, hey, can you please take this off of my credit? So please do not do that. That is, again, a surefire way to get a note called. The best way to make sure that they don't get it called is just to make those payments on time each and every month. There's also a little note here that for us, we buy our properties in an LLC. So when we're buying these properties for rental properties, What we do is we name the LLC with a special naming recognition. We use the last name of the prior owner dash the street name of the property. The reason why we do this is because in 1982, the U.S. Congress initiated something called the Garn-St. Germain Act. In the Garn-St. Germain Act, it allows for property transfer in terms of putting it into a trust to build in that protection around the trust and to allow for the property to transfer through the family and possibly without having to go through probate. Okay? This is a really big deal. So when a bank, for example, looks to see who owns that property and they see the last name of the prior owner dash the street name of the property, what does the bank think that that person has done? Transfer the property into, for example, a family living trust. And they think that the prior owner is still what? The current owner. So for us, that's been a great way to be able to provide that additional insurance policy, that additional protection to make sure that we don't get a note called. So buying subject to, first you'll want to find the property. You've got to use the different marketing strategies that Phil spoke about earlier. You'll need to explain to the seller that you're going to buy the property by taking over the payments on the seller's existing loan. This will save you money as a real estate investor. Again, I went through the example of if your alternative is buying a property with hard money, this is a great way to save yourself some money. Now, you can pay the seller more. You can pay the seller some of those savings, right? So, for example, if it's $8,000 in origination fees, right, 4 points on a $200,000 loan, that's $8,000. You could afford to pay the seller that full $8,000. What I have found is it's usually somewhere between $2,000 and $3,000 and usually not more than $5,000 that will move a seller from not wanting to sell with you with keeping the loan in place to desperately wanting to sell to you and be able to keep that loan in place. It also avoids appraisals, avoids waiting on the lender to approve the loan, and the condition does not matter, right? Because you're not getting a new loan in this case. You'll use the TREC contract. So again, you can get the TREC contract, just Google TREC, T-R-E-C, and you can find the contracts that you need to be able to do this. You'll take your contract along with the earnest money over to the title company so they can do the title work and prepare all the documentation. You'll close on the property again at the title company. The general warranty deed, also just called the deed, transfers to you. So now you are the owner of the property. The loan stays in place. The loan does not get paid off. The title company will create a new loan, a new note, and a deed of trust that I, as the new owner, will sign, and the person that I'm buying it from is now effectively the bank. So they're effectively Wells Fargo, Chase, Bank of America. Does that make sense? So if I stop making payments, guess what that seller gets to do? Foreclose on me, right? So that's what will give them that extra layer of protection. You can use multiple exit strategies here. Again, you can buy, fix, and flip, buy and hold. You can keep as a homestead. You can sell on a wraparound mortgage, which is a great strategy to be able to effectively wholesale your property to an end buyer who might not be able to traditionally get approved for a loan. It's also a great thing to sell to other investors. So not only is there the glass ceiling that we have as real estate investors for only being able to get between 4 and 10 loans in our own name, there is also another glass ceiling, if you will, for real estate investors, and that is if you are working full-time as a real estate investor and you find a house that is a great house and you have great credit and you have lots of money in the bank, is a lender going to make you a loan if you've only been investing for the last 6 months or the last year or even the last 2 years? The answer is no. They want to see 2 years of what? Tax returns that show that you've been in this business and that you know what you're doing. So even though credit score, wonderful, great, that's important. Even though money, cash in the bank is wonderful, great, that's important. They have to have the whole picture in order to get the loans. That's why it's a great strategy to use even for an investor who's buying a homestead as well. Now, you will have to overcome objections. Some sellers don't want to sell their house subject to the existing financing because they don't want to leave their loan in place because they're scared that you're going to not do what? They're scared that you're not going to make the payments, okay? How do you convince them to believe that you're going to make the payments, and how do you convince them to believe and understand that this is actually something that could be very beneficial to them? So would you and many of you guys in here might be thinking, well, I would never sell you my house subject to the existing financing. That would be ridiculous. I would never risk my credit. Well, for those of you guys that are in this room right now, yes, you guys all have perfect credit. You guys all have perfect income. You guys all have cash in the bank. And guess what? Not only am I never going to buy a house subject to the existing financing from many of you guys, I'm never even going to buy a house from you under any circumstance from any of you guys. Is that true? Right? You guys are not my target. You guys are my anti-target, right? You guys are going to put your house on the MLS. You're going to sell for full retail. You're going to sell it to a retail buyer. They're going to get a retail loan. Your house is going to be in perfect condition. I'm not buying from any of you guys. The person that I'm buying from is someone who might not have much equity because they burnt it up maybe by not making payments. It's someone who's been behind on their payments possibly from anywhere from 2 to 4 months to as long as 12 to 24 months and has been fighting the bank and going to foreclosure. And in that particular case, guess what? It's someone who has already done what with their credit? Ruined it, right? Ruined it. So if your credit was ruined and I offered you a way out that helped you avoid foreclosure, would that be a great alternative for you? And the answer for most people is absolutely. So what if the house needed to be renovated? You didn't have the time, money, expertise, or connections or network to be able to do it? What if you were facing foreclosure? What if you wanted or needed to sell quickly, right? We have people who have to move. It feels like people only move to Austin. It feels like no one ever moves out from Austin. But what if that one person did exist, right? But sometimes people do need to move or sell quickly. There are different circumstances that come up that require some of those transitions. And again, what if you couldn't sell to a regular retail buyer because it was uninhabitable because of the amount of repairs that property needed? Now, to be clear, do not confuse uninhabitable with someone can't be living there. Because let me tell you something, people live in what a bank might consider an uninhabitable situation all of the time, okay? That doesn't mean that you can't buy it with a hard money loan, but it's specifically and so easy for you to be able to buy it subject to the existing financing. So some of the objections and how you overcome them, these are some of the things that I will say to overcome them. Why would I buy your home, bring your loan payments current, and then just stop making payments, right? I'm not doing this for fun, right? If I wanted to blow $20,000 reinstatement and a $50,000 renovation, if I wanted to blow $70,000 cash, there are a lot more funner things that I could do with that than throw it into your house, right? So that's one of the things that I get to say. Working with me now and stopping foreclosure is better than risking it in the future. So a lot of people think, well, what if you don't make payments on my loan? Again, why would I reinstate? Why would I make those repairs and then stop making payments? And then, of course, I get to build back their credit score. So what happens when I'm making payments on time each and every month? What happens to their credit score? It starts to go back up, and that can help them get into a house later on in the future. I'll talk about my financial stability and the fact that I've been doing this since 2003. You can use borrowed credibility and say that you and your partners, if you bring me in on the deal, has been doing it since 2003. And basically, I let them know that I have skin in the game, right? So I've got my real money in it. And in many cases, I have more money, and I will have more money invested in that property than they did when they first bought that property, which makes a big difference. So these are some of the things that you say to be able to overcome the objections of why, when someone says no, when you ask them to sell their property subject to the existing financing. Guys, does anyone in here still have a buzzer for membership? A buzzer? You do, but you don't need it. That's right, because you're already a member. So I think we're good. If there's anyone in here who would like to join us in membership, they're closing the membership table right now. So if you'll step out and see Kaylee, then she'll help you get set up with that. But they are closing, so it's last call for membership. Thank you guys. So some of the tricky details, you'll want to fill out what's called an authorization to release loan information. This is the form that will allow you to call the bank on the owner's behalf to request the payoff, the reinstatement, escrow analysis, and really understand the numbers behind the deal. For us, when we buy these properties, we buy them in an LLC. So I told you what our naming recognition is earlier for what we do as real estate investors too. Some other tricky details, we talked about this. You need an insurance policy. The declaration page has to accurately state not just your name and your company name, but also the prior owner's name. You'll want to verify the liens on the property. The title company will help you do this. And you'll also want to get a copy of that prior or that existing promissory note. So you know the terms, you know the interest rate, you know the amortization schedule. You know if it's principal and interest only, or if it's principal, interest, taxes, and insurance. So you want to understand what those terms are. You'll want to change the mailing address where the mail goes, because occasionally the lender will send checks when there is an escrow adjustment. In fact, on one of my subject to properties, I just got an $800 check, which is a little unusual. Normally they're asking you to pay more, but this past time I got an $800 check that said, hey, you're over escrowed. Your taxes and your property taxes, we collected too much money for you, and they were less than what we thought they were going to be. You'll also get something called a 1098 interest expense statement. So just like right now, for if you own a house and you've got a mortgage on it, every year by January 31st of the next year, they send you what's called a 1098 interest statement. It explains how much interest you paid on that property for that prior year. That interest for many people is something that they can write off on their taxes when they do their taxes at the end of the year. So what are the advantages? The loan is not in your name, but the deed is. You get to take advantage of all of the appreciation. You get the cash flow. The tenant gets to pay down the loan for you over time. It's a great way to bust through, again, something that we call that investor glass ceiling. And what we've found is, at least for us, it has been the process, the path to creating wealth for us as real estate investors by allowing us to build a larger rental portfolio that's been appreciating like crazy over the last 16 years that we've owned it than we otherwise would have been able to doing it the traditional route or just paying cash for properties. Does this resonate for you guys? It should. I hope it resonates big time, because this is a great way for you guys to make money, build your retirement, and live the lifestyle that you want. So the truth about buying subject to is that a lot of people with perfect income, perfect credit, perfect lives, guess what? You don't believe that anyone would ever actually do this, right? But that's okay. We're not buying from you. We're buying from people who are effectively the subject of a country music song. Their wife has left them, their job is gone, their truck died, and their dog died, right? We're not buying from any of you guys. We're buying from people who have had some significant decrease in their income and or some significant increase in their expenses. Once you're able to kind of get out of your own mind, you can see how a seller might want to be able to do this. And in some cases, when they wait to the very last minute to approach you about being able to stop the foreclosure and purchase their house, man, sometimes this is the only way that you can get it done and the fastest way that you can get one of these deals done when that is indeed the case. The truth is that it does get a little awkward changing payments because every March they do an escrow analysis. In fact, this month we got one early, and they usually ask you to increase your payment. Every other year or so they change the servicer, so they tell you to change who you're writing your check to. But you would have that same awkward path just owning it in your own name and having to be responsible for that. But it is truly the essence of wealth creation, and we recommend that you use this on every single deal that you encounter, because again, it will allow you to do more deals and generate more income and more wealth for yourself over time as a real estate investor. So guys, I hope this was as powerful of a presentation for you as it has been powerful in my own business. And I will say, guys, thank you all for being with us here tonight and joining us as part of the Investor Association. And we look forward to seeing you at the next meeting. Thank you and have a wonderful night.